Mutual funds, index funds, exchange traded funds, even hedge funds. There are so many different types of funds out there. So in today's video, I'm going to tackle those, give you an understanding of what they are, the differences between them. Stick around to the end of the video because by then you'll have a really good understanding of all these different types of funds and most importantly, which ones are right and best for you. All right, so let's get into it. So mutual funds, they've been around for a long time. And what a mutual fund is really, it's a pool of money. So let's say you buy into a fund and hundreds of other people buy into a fund as well. Well, a fund manager will take that pool of assets and they will make the decisions on which stocks to buy as part of that fund that they run. And funds will have a mandate, if you will, like large cap equity or small cap technology, whatever, something along those lines. So that'll all be very clear in the documentations before you invest. But the fund manager themselves, they set up their company, they hire loads of analysts, and they go to work doing the research and try and pick the best companies within that particular sector or you know, market cap, for example, that they're focusing on. So if it's a large cap equity fund, for example, then they may look at, say, the S&P 500, and they may go and try and pick out, say, the 50 or 100 best companies that they think will outperform the actual index, the S&P 500, over the next few years. And all of the money gets pooled together and they'll buy those stocks. They're good in terms of getting some sort of diversification because you'll get access to, you know, 50 or maybe 100 different companies. But a couple of things to be aware of when it comes to mutual funds. The main thing is their fees. Obviously, that fund manager needs to be compensated and all of those analysts and everybody needs to be paid. So they're going to charge around 1 to 2%, which may not sound like a lot, but if you compound that over 20-30 year period, then it actually is quite significant and can really hurt your returns. The main question to ask when you're looking at a mutual fund is, am I getting a return for that fee that I'm paying? And is this fund manager actually outperforming the market? Because a lot of them don't. There's a great book out there. Jack Bogle, the founder of Vanguard, wrote a book called The Little Book of Common Sense Investing. I recommend you read this. But he's run the data, and basically what he will show is it's very hard to pick the fund manager that will outperform the market over the next, say, 5 to 10 years. It's nearly impossible. So they're really challenged, and for this reason, they may not be the best for you because you're just going to be paying 1 to 2% and you may not get the return that you need. But that is what mutual funds are. Have a look at them and see if they're right for you, but do bear in mind the costs, and most importantly, are they outperforming the market? Up next is the index fund. Now, I mentioned Jack Bogle a few minutes ago. Well, in 1975, he created the first index fund that tracked the S&P 500. And his idea was, because mutual funds and actively managed funds, like I mentioned, where they're trying to outperform the market, because they've not been able to do that successfully, he felt investors were better off just investing in a fund that didn't try and pick the 50 or 100 best companies, and actually just spread the money all across the top 500 like the S&P 500. Think of it like this, as he described in the book. Rather than trying to find the needle in the haystack, that is the best companies to invest in, his motto was just buy the whole haystack and you will take the market return. So you'll get the market return, for example, like the S&P, which has been around 9.8%. And the best thing about the index funds, and when he invented this, was you were able to do so at a low cost. So whereas a mutual fund might charge you 1 to 2%, you can pick up index funds for like 0.05%, 0.04%, much lower fees. And his view is that when you invest in an index fund, you'll get the market return minus your fees, 0.045%, like I mentioned, and therefore the return to the ultimate end investor, you or I, is going to be higher. So it's been really successful when he's come out with index funds, and this is also known as a passive management strategy. So active is a mutual fund where the manager tries to outperform the market, and passive is where you just sit back and you take the market return. So with an index fund, they'll take the pool of money and they'll just buy each of the companies named in, say, the S&P 500 or whatever equity fund that it's going to be tracking, or the index like the FTSE 100 as well. So it's a way to passively invest into the market. There's been a lot of data that shows a lot of investors have moved from active into passive over the years, something to the tune of around $1 billion a day actually in the US, moving from active strategies to passive. So there's been a big shift into index funds over the years. So if you want to just track the market, then index funds may be the right one for you. So one thing that you want to watch out for, although the fees can be lower, around 0.04, 0.05%, like I mentioned, they can have a higher minimum investment. Sometimes you need at least 3,000 or 4,000 to get started. You know, some of the Vanguard funds out there, you know, they start at $3,000. So they may have a bit of a minimum requirement to get in them. So those are index funds. Okay, then we have exchange traded funds, also known as ETFs. These are getting more and more popular. They started up sometime in the 90s, and what they are is they're very similar to an index fund, which is not traded on a stock exchange, but an exchange traded fund therefore is. So the fund managers set up exchange traded funds, and these will trade on a market just like a stock does. So if you have a brokerage account, you can just log in and buy or sell an ETF whenever the stock market is open. Whereas with index funds or mutual funds, they're generally just priced once a day. So they have a little bit lower of liquidity. But with an exchange traded fund, you can buy and sell. The fund manager will have the shares created, and if you buy an ETF, you're buying it actually from the seller. So they're a lot more liquid, as in you can trade them a lot more during the day. But this has a downside as well. A lot of people's behavior, and I've certainly seen it over my 20 years in the financial markets, it can induce people to be actively trading on an ETF on, say, the S&P 500, like the SPY, SPY, or VUSA in London. And people can get very active and start trading them, whereas the strategy for these is more meant to be buy and hold, passively investing over the long term. So that can be one of the downfalls of it. You'll pay a brokerage commission as well, but they can be cheaper because it depends on the custody fees that you're actually being charged. Custody fee is just a fee that your broker may charge you for holding a mutual fund, an index fund, or an exchange traded fund. But one thing to look at is, do you have any custody fees? Are you just paying the commission? And then also taxes. There can be some, depending on where you're located, there can be some additional taxes on, say, index funds versus an exchange traded fund. So an exchange traded fund may be more cost effective, and it's certainly easier to get exposure to, and they've gotten so much more popular. VOOO, the VOO in the US, is an S&P 500 tracker by Vanguard, very popular. VUSA on the London Stock Exchange, very popular. Both of those track the S&P 500, but ETFs have come on big time in the last 10 or 20 years. There's literally thousands of them now. The final fund that I thought I would mention, we won't spend too much time on it, but a hedge fund. A hedge fund is tends to be more of a private type of fund with a very high minimum requirement. They're not really there for the average investor, but what they like to do is a hedge fund will have an active strategy with a particular mandate to focus on particular areas of the markets, but they're not limited to just stocks. They can actually get into pretty much anything. Forex, derivatives of some type, futures you can trade as well, the hedge fund manager can do. And their mandate really is to make money in all market scenarios. So if the stock market crashes, they'll try and make money by maybe going short on an index future where you profit from a falling market. The thing about hedge funds, and they're difficult to get into, they're typically for professional investors or institutional investors like, you know, pension funds and everything, but they have unbelievably high fees. Typically 2% of the assets they have under management on what you give them, and then 20% of profits. So they are great for the hedge fund manager, but they're not so great for the investors. So for someone like you, it's probably not even worth really looking at, but that's what hedge funds are. There are some really popular ones for sure. They get a lot of media attention, like Bill Ackman's fund, for example, at Pershing Square. But for the average everyday investor, probably just better avoid it. One interesting bit about hedge funds. In 2007, I believe, Warren Buffett put a bet out for $1 million for charity against any hedge fund. He would only buy the S&P 500 tracker fund, and he would take on any hedge fund, $1 million each, and in 10 years time the pot would go to charity. And of course Warren Buffett won simply by buying an S&P 500 ETF. So don't think for a second that you're missing out by not getting into investing into a hedge fund. They're probably best avoided given those fees. Okay, so those are the four major types of funds that you have investments in. Now, what do? I do ETFs. Why? I just find them easier to get invested into. Obviously, they trade during the day, but also where I'm located in the UK, my broker does not charge much, if any, custody fee to do ETFs. Whereas for an index fund, they would charge me 0.45% just to hold the fund. So when I do an ETF, I pay 0.1% for the fund that I'm invested in, and I pay a commission fee when I buy it. But if you can do an automatic investment, which which I've mentioned many times in this channel, then you may even be able to get around the commission fee to execute the trade. In my case, because every month I do a direct debit into the market, it buys my ETF automatically, I pay very little to no actual commission fees to do this. So I'm actually getting invested to an ETF very easily. But check your broker and what their charges are. If you don't have any custody fee at all on an index fund, then maybe you want to look at that. But again, think about the tax advantages or disadvantages on those. What you don't want to do, if you do ETFs, and you can also do fractional shares with ETFs, so you can start with even less amount of money. But what you don't want to get into is actively trading the ETF. If you think you're going to go into ETFs and buy the S&P 500, for example, and be actively trading it, trying to time the market and everything, ultimately your results are going to be pretty poor. I've seen this so many times, it's crazy. So you want to avoid that. Whatever is going to more likely make you a long-term investor for cheap, that's the best way to go and the right one for you. So have a look, find out what your broker, if they charge you a custody fee on an index fund, if they charge you a commission on an ETF. If you're just getting started and you don't have much money, will they allow you to do fractional shares in an ETF, for example, and decide which one is best for you. But I think you should narrow it down to index funds or ETFs, and based on cost, go with the one that's best for you. Long-term investing, auto-invest that money every month into that fund, and I guarantee you, as somebody who's seen hundreds, if not thousands of client accounts and what they do on their trading strategies, the buy and hold in the index funds or an ETF on the market tractors always outperform. Okay, they don't outperform the market because they're taking the market return, but they'll always outperform a more active investor, okay? So bear that in mind, keep it long term, keep the emotions out of check. That's my video on funds. I hope you enjoyed the video. If you did, why not subscribe, give me a like, share the video with somebody who you think might benefit from this information. It all helps me out. I'm a small channel, growing. I've got a lot more videos to come though, so feel free to subscribe, and I'll see you in the next video.